Holy smokes, Chris, that was a lot of fun. And so I am really excited for everybody to watch what we just recorded, all about making the best of your opportunities in this market in regards to all sorts of fun stuff. So Chris, what was your favorite part about what we just recorded?
When I put this kind of together, the numbers, Mark, we used two different scenarios. And at the time that I put it together, I didn't really think about tying the two together. So I thought it was interesting in our discussion. It came to my mind that tie the two together was really important. How about for yourself?
Man, you stole mine. I can't think of a new one fast enough. But yeah, it's really when you put it all together, it just makes so much sense. And there's so much opportunity right now. So everybody stay tuned. We're about to start this next episode. You're going to like it.
Hey, everybody. Welcome back to SoCo's Most Interesting Podcast. I'm a co-host, Chris Bongirno, and the other co-host is here with me today, Mark Ditkof. How you doing today, Mark?
Chris, I have decided I'm going to make this the best day, the best Wednesday I have all week.
Well, that's great, Mark. You always put pressure on me because every day seems to be your best day, which is great. And I like to say that, but I can't always confirm that that's what's going on. But honestly, today is a good day. It's a good day for a number of reasons. And one of them is what we're going to talk about on the podcast today, because what we're going to talk about are two things that I run across in my practice of being a kind of a home loan coach, if you will. And discussing with people two different things that really can impact a buyer who's going to use financing to purchase a home. And the first thing we're going to talk about is, and we're going to use an example here of an FHA loan, because I think that's really very common in not only our marketplace, but just nationwide as well. So we're going to be talking about FHA loans, and we're going to talk about, should you pay more for a home and have the seller cover your closing costs, or should you pay less for the home and pay your own closing costs? And then after we kind of flesh that out a little bit, we're going to talk about whether it makes sense to pay to get a lower interest rate. And we'll talk more in detail how you do that and why you would do it and whether it makes sense. So does it still feel like your best Wednesday all week that we're going to do a deep dive in some of this stuff, Mark?
You know I love numbers, and so you just got me all jazzed up. I'm really excited to have this conversation right now. So let's just get right into it.
Sounds good. And so I want you to, it comes up anyway when we do these podcasts, but I want you to jump in with questions or insights as we go along. So basically what we're going to do, folks, is we're going to talk about, in all of our examples today, a sales price of $300,000. And again, we're going to be talking about an FHA loan in all of our scenarios. And we're also going to talk about, in this particular case, that our closing costs for this loan are going to be, we're going to use a value of $6,000.
Hey, Chris, what are closing costs real quick? Just real 20 seconds. What is that?
That's costs that you pay at closing. What it is, Mark, is the fees that third parties charge in order to provide services, in most cases to the lender, so that we can get your loan closed. That includes title, appraisal, credit, lender fees, government fees like recording fees, tax stamps, those kind of things. Okay. So it's the costs associated with buying a home and using financing.
Yep. So if somebody's buying this $300,000 home and they've got $6,000 in closing costs, that would be on top of the $300,000 purchase.
Yeah. And yep. So what you would want to think of is you're going to need your down payment plus closing costs. And in our other example that we're going to talk about with this is your down payment and having the seller cover your closing costs.
I love it.
The other thing I want to say here is a little bit of a disclosure. This is very general. I highly recommend that when you move forward with purchasing a home, that you have this discussion with your real estate professional as well as your lender. This is not an offer to lend. We're not talking about any annual percentage rates or anything. These are example purposes only, just to discuss concepts. The other thing I want to mention, we're only going to talk about monthly payments using principal and interest. We're not going to include taxes and insurance and mortgage insurance, which are all part of your monthly payment. So the numbers that we talk about for monthly payments are going to be lower than your actual monthly payment because we're just going to include principal and interest. Does that make sense?
I got it.
And last thing, we're going to use an interest rate of 7.5%. That's not a high interest rate. It's just not historically low. I think that represents a good number across different lenders. And so that's why we're going to use that today. So what we're going to talk about first, Mark, is do you pay more for a house and have the seller cover your closing costs, or are you going to pay less for the house and pay your own? So if we're looking at a sales price of $300,000, we're using FHA, your down payment is going to be $10,500. And we're going to use closing costs of $6,000. So if you reduce the sales price, let's go back. If the sales price is $300,000 and you have the seller pay those closing costs, what you're going to need out of pocket is $10,500. If you reduce the sales price by $6,000 and you pay your own closing costs, now you're going to need $16,300 out of pocket. Does that make sense?
Yes.
So the money you need at closing is going to go up significantly from roughly $10,500 to $16,300. However, because you're borrowing less money, you're going to save $42 per month in your monthly payment. So if you buy the house for $300,000, your principal and interest payment is going to be $2,060. And if you buy that same home for $294,000, your monthly payment is $2,018. Any questions so far, Mark?
Okay, so I just want to make sure. So we're not talking about adding the $6,000 on top of the $300,000 purchase. Really, it's if the seller is going to pay it or not. Really, so it's a $294,000 house is what we're working with. Are we going up $6,000, having them pay the closing costs, or at $294,000 are we just going to pay our own? Is that what I'm hearing?
So let me tell you what my thought process was in putting this together. The home is listed currently for $300,000. Should you walk in and offer $300,000?
Got it.
And $6,000 of the seller paying your closing costs, or should you do a below market off or below asking price offer of $294?
Okay, we're on the same page now. I like it. Okay, so we're going to save $42 a month if we offer $294, but we're also going to have to then pay almost $6,000 more upfront. So I guess, Chris, then is the question, how quickly do we make that money back?
Yeah. And the second part of that, and I'll get that here in just a second. The second part of that, Mark, is really what's most important to the buyer.
Yeah.
Right. If the buyer's got $10,500 in the bank, pretty easy question to answer, right? They don't have the extra money. So in that case, it's not really a choice. What we're talking about is somebody that would have the extra money available to do the second option of paying less for the home and not having the seller paying closing costs. So roughly what it comes down to is in 4 years, you save approximately $3,200 in interest if you pay your own closing costs. Okay? So you have two things, right? You're going to pay $6,000 more in costs to save $3,200 in interest in the first 4 years. Does that make sense?
Mm-hmm.
So in reality, in 4 years, you're not really ahead yet, right? You're not really ahead. And that's going to get better over time, but you're really looking closer to quote unquote breaking even in about year 6.5. And that's when you kind of break even in this. So in a lot of cases, again, it's not going to be every case. In a lot of cases, you're better off paying a little bit more for the home and having the seller pay those closing costs. Now, you do end up ahead, okay, over time by paying less for the home and paying your own closing costs. You're also saving money every month, right? That monthly payment we talked about was $42 a month less. And that can be important to a lot of people, that $42 per month. So again, this is really just to give you some food for thought, and get you in touch with your mortgage person or your real estate professional, and kind of hash through this and what makes more sense for you. I have tools at my disposal, and a lot of lenders do, where we can just plug in numbers in both scenarios and just spit this out within just a couple minutes and give you some individualized answers for this particular scenario.
So one thing too that I guess is worth mentioning is the opportunity cost of money is something that I always like to talk to my buyers about. Unfortunately, most people don't maximize their money, right? I mean, it just doesn't happen, right? They end up, if you got an extra $42 a month, they don't put it in an interest-bearing account or mutual funds or whatever. They're not earning more money on that. Typically, they'll go out to eat once more per month. They'll buy one more thing off of Amazon. They'll do something like that, which maybe improves their life, maybe doesn't, right? But if we were going to be purposeful and mathematical about our savings, a question then people need to say is, okay, if I'm going to finance my $6,000 in closing costs by offering the full, can then that $6,000 that I don't spend at closing, can I put that in a situation that it grows better than $42 a month that I would save otherwise? And so that's where people need to see are those opportunities. And then not only, okay, now maybe I found a place I could put it that's absolutely going to do that, right? It's going to better than 7.5% in our situation, right? It's going to earn me more than 7.5% interest. Am I actually going to do that though? Am I going to take that money and is actually going to go there? Or is it just going to be money that I eventually spend and it doesn't maximize? And so those are conversations always to have as well.
And one of the things that your mortgage professional can help you with too is sometimes, it's unrealistic that you're going to earn more than 7.5% on that 6,000. But if you've got a credit card with a $4,500 balance at 28%, take that extra money and pay off that credit card. You're not going to be earning money with it, but it's certainly going to reduce a very expensive form of borrowing on a credit card. So
that's a great idea, actually. Do you have a car or a credit card or a personal loan or whatever it is that's at a higher interest rate? So again, if I can finance this $6,000 at 7.5% is essentially what you're doing. Right. Could I then take that $6,000 and instead of earning better than 7.5%, can I pay off something that's costing me more than 7.5%? Sure. Now, again, we are running that 7.5% over 30 years versus a car loan or those kind of things are typically amortized quicker, but the idea is there. And so hopefully people understand that there are options available.
Yeah, absolutely. The second scenario that I wanted to talk about this morning, Mark, is should you pay points on your loan when you purchase and you get a home loan? And so what you can do, concept to understand here, the word point really means percentage. So should you pay a percentage of your loan amount up front as a cost to get a lower interest rate than if you don't pay a percentage of your loan amount at closing? So should you pay points? And points are a percentage of the loan amount you pay up front so you can get a lower interest rate. Is that confusing or was that a good explanation, Mark?
No, yeah. So if the current interest rates are 7.5%, that's going to cost me a certain amount each month. I could also pay money up front, whatever amount we were going to use in our example, right? And that would then reduce my interest rate to 7% or whatever it's going to be. And how much savings is that going to benefit me? And therefore, again, kind of like the last example we just talked about, is that the best use of the money, right?
Right. So what we're going to talk about, just as to recap, sales price of $300,000. We're going to use an interest rate of 7.5% at 0 points. So that's our base interest rate, 7.5%. And we're going to compare that 7.5 at 0 points to an interest rate of 6.75% at 2 points. So what that means, Mark, is that at an interest rate of 7.5% and 0 points, we're looking at a monthly payment of principal and interest of $20.60 per month on an FHA loan. And we're going to compare that to the monthly payment at 6 3/4. That monthly payment is $19.10. So that difference in interest rate is going to equate to $150 per month of savings per month in monthly payment, but that comes at a cost of $5,891. So the 2 points is 2% of our loan amount. So, and it's going to look off a little bit because it's not 2% of 300,000. It's not 2% of our sales price. It's 2% of our loan amount. So what that means, just to clarify, is that an interest rate of 6.75 will get you a lower monthly payment of $150 per month, but it will cost you roughly an extra $5,900 than an interest rate of 7.5%. What questions you got for me on that, Mark?
I'm already running ahead. So you did a great job. One thing to note,
it's a little confusing.
Hey, if a lender says at 2 points, and points mean percentage, like you said, but doesn't mean 2%. If you're going to pay 2 points up front to get your interest rate down, do notice that's not a 2% decrease in your interest rate, right? We're not buying down from 7.5% down to 5.5% for $5,900 essentially, because everybody would always do that, right? Because that's going to make you a lot of money in the end. Here, we're actually only getting 0.75% on our actual interest rate down, with a $6,000, $5,891 upfront payment. So I already ran the math. Can I spoil it?
If you did it the same way I did.
I said if we spent if we're $5,910, where did I get that from?
Say that again.
$5,910. Is that how much it costs? No, it's $5,891.
$58.91.
Divided by $150 per month savings. It's going to take us 39 months to break even, right? And so 39 months, what is that? But divided by 12, we're going to be about 3.25 years. So 3 years, 3 months,
right,
will be about your break even. So Chris, if I'm buying a house and I say there is all intentions and likelihoods, I'm going to be in this home for 5 to 6 years, 7 years, whatever, right? Probably worth doing, right? If I've got the money up front.
So yes, in many cases, but let's talk about this a little bit further before we answer that question definitively. And so I rounded up and said 40 months because it's right at about, it was 39 and some change. So I used 40 months. So a couple things to consider. At some point in the next 40 months, you may refinance because rates have come down. And that's something to consider, but not count on. Mm-hmm. So in your discussion, you need to think of that. The other thing that we need to consider is, instead of buying down that interest rate of, I'm going to round up $5,900, what if you kept the interest rate of 7.5% and took that $5,900 and added that to your down payment?
Mm-hmm.
So if you do that, it actually takes you 55 months to break even. And
so you're better buying the rate down in that particular instance because of timing there.
In that case, you are. So we've eliminated more down payment as an option. So now we're looking at kind of what you were just saying. Is it better, if you're going to be in that home for 5 years, is it better to have the interest rate at 7.5%, or is it better to buy down the interest rate? What really comes into that is how long you're going to be in that home. But it's also, how long are you going to have that particular loan? So if you think it's very likely that you're going to refinance in the next 3 years, I would say you may want the higher interest rate. because there's going to be a cost associated with refinancing. If you're looking at it, well, no, I think, in your opinion and your loan officer's opinion, it's unlikely you're going to refinance in the next 3 years, then I think buying down that interest rate becomes a better idea.
So we're using an FHA loan as our example. So if I want to refinance the next 3 years, there's a few things that need to happen. Rates would need to go down to make it worthwhile. I would still need to have the income and the credit score that I could qualify for what would probably be a conventional loan refinance, right? That's what I would probably refinance into.
Likely.
And I have to have 20% equity, right, to do that refinance.
Negative.
What equity percentage do I need?
Realistically, if you were going to go to conventional, you just need to have 5% equity, or basically a 95% loan to value. But that's so you could finance your closing costs in your new loan amount. So you would have to look at not only interest rate, but then also mortgage insurance. Does it make sense to refinance? So there's a lot that goes into that, which probably goes outside of our discussion today. But what I would tell you is that in most cases, you're going to want to account for that possibility of refinancing. One thing that I want to add on this, though, is that if we combine these two scenarios, right?
That's where I was just going to go.
Yeah. In our first scenario where you're talking about, does the seller pay closing costs or not pay closing costs? And in this scenario, we're talking about, should you pay points to buy down the interest rate or not? What I'll tell you is what's a really good thing to look at, and in many, many, many cases, especially the way interest rates are today, is you have the seller pay down your interest rate by paying points for you and paying more for the home.
Not only, so we could, in our scenario, we've been working at a $300,000 home. We could say, look, we want you to pay $12,000 in closing costs, because I believe that's within the FHA guidelines, but I'll let you verify that. But I want you to pay $12,000 in closing costs, but I'll raise the purchase price $6,000 to help cover those. That's an option, right? Or could I just say at $300,000, I want you to pay $12,000, right? So essentially you're offering them $12,000 below asking, but I want you to pay all my closing costs and buy down my rate. That's an option if the seller's willing to adhere to it. But then again, we could raise the purchase price a little bit, finance these as well, and you'd still want to run this math. What's my break-even point? Can that money be optimized somewhere else? And is there a better chance that I refinance, and so I don't want to finance these closing costs? Does that sum it up a little bit?
Yeah, exactly. And just to be clear, Mark, currently, as of our recording date, and I don't expect it to change, FHA allows 6% of the sales price to be paid by the seller towards financing concessions. So in our particular case, they could really pay up to $18,000.
Right, but you got to use them for closing costs or buy downs, and a buyer's not always going to be able to use a whole 6%.
Correct. However, they could, because what we could do in this particular case is, instead of buying it down by 2 points, buy it down by more points. Right?
At a point, it stops being eligible, though, right? You can't buy a rate down to 0% with enough money, right? They don't allow that.
Not down to zero, but I mean, we could take a look at buying it down, paying 4 points to buy down the interest rate, and then cover closing costs on top of that. That would probably get us close to that $18,000.
I just love that idea.
Yeah. So especially in our particular markets in Southern Colorado right now at the end of 2023, depending on the home and the circumstances, sellers are willing to make concessions now that 9 months ago, 12 months ago, 24 months ago, you'd have very little opportunity to find a seller willing to do these things. So I think there's this trade-off between, interest rates are not high, but they're not at historic lows, but they're higher than they have been. But if you can get into a home and get a significantly lower interest rate and monthly payment, you're better off buying now before the market turns into an even more seller's market than it currently is, because then you're not going to get any concessions. And we saw that very prevalent 2 years ago. So I think having discussions with your real estate professional, and I think your real estate professional, your real estate agent, should be a part of this discussion. Just like you and I had today, you had questions that I didn't necessarily address when I was thinking through these things. And I think the real estate agent has a relationship with buyers where questions get asked and there's a discussion that happens outside the presence of the lender. So I think it's really important that the three parties all get together at some point and have this discussion if you're looking at either one of these options.
Chris, this was fun today. Thank you for bringing this topic up. If people want to find you somewhere online, get a hold of you, where do they find you?
Look in the comments down below. With the spelling of my last name, it's easier to just get everything down there. And then, Mark, if people need some clarification on things we've talked about or want to reach out, where do they get a hold of you?
You can find me on any of the major social media platforms at Onyx Home Group. That's Onyx with a Y. Don't forget to like and subscribe to our YouTube channel. Send us DMs, comment in the post, whatever it is. Give us questions and topics, because that helps us get the information that you guys want the most. So, Chris, it was a pleasure today, and thank you for helping us with SoCo's most interesting podcast.
Thanks, Mark. I'll see you next time.